All right, today we're going to dive into a really radical economic idea. One that could totally rewrite the rules of government finance. Just think about this for a second. What if a country decided to set its main interest rate to zero and just leave it there, forever? Let's break down what that would even mean.
Really try to picture that. We're not talking about a temporary fix here, something you do during a crisis for a year or two. No, we're talking about this being the new normal. This isn't just tweaking a number on a spreadsheet. It's like changing the entire operating system of an economy. So what would actually happen if a central bank just locked its main rate at zero for
0%. That's the number. And again, this isn't just another rate cut you hear about on the news to try and juice the economy. The proposal we're digging into today is all about a permanent, fundamental shift. Can you imagine a world where the base cost of borrowing money is just nothing? It's a mind-bending idea. Okay, so what does a permanent zero-rate policy actually mean in practice? Let's take a closer look at this proposal, because it would basically force us to reimagine the whole point of a central bank and its most powerful tool, the interest rate. So the basic idea is pretty straightforward on the surface. A country's central bank just sets its main interest rate to zero and says, that's it, we're leaving it here. But as you're about to see, that one single decision would set off this huge chain reaction, a cascade of changes that would completely reshape the entire financial system.
Okay, so how would you actually make this work in the real world? It's not as simple as just making an announcement and calling it a day. To make a 0% rate permanent, you'd need to take a few very specific, interconnected steps to really lock it into place.
So here's the four-step playbook. First, boom, the RBA sets the rate to zero, permanently. Step 2, and this is crucial, commercial banks can get unlimited overdrafts from the RBA at that 0% rate. So, free money on tap, basically. Third, the government stops selling long-term bonds. And finally, to tie it all together, the RBA offers to buy up any existing government bonds to force their return, or their yield, down to zero. See how it all fits together? It's a closed loop, designed to make that 0% rate the absolute, unshakable foundation of the whole system.
So what happens next? If a government actually did all that, what would the economy even look like? Well, this is where it gets really interesting, because the proposal outlines some massive and totally intentional ripple effects that would hit the financial industry and the government itself.
So, first things first, the market where banks lend money to each other overnight, that would pretty much just disappear. Think about it. Why would you bother borrowing from another bank if you can get unlimited, interest-free money directly from the central bank anytime you want? You wouldn't. The whole market just becomes obsolete. All right, next up, the whole market for trading government bonds, it would basically collapse. If the central bank is standing there, guaranteeing it will buy any bond to make sure its return, its yield, is always zero, well, there's no money to be made speculating anymore. The whole reason to trade them is gone. The profit motive just vanishes.
And this leads to a huge payoff for the government. You know that massive line item in the national budget for interest payments on its debt? Well, it would just be eliminated, gone. That entire expense, which can be billions and billions of dollars, would just, poof, disappear.
Now, according to the proposal, this would set off some pretty massive shifts in the job market. Think about it. Entire departments, maybe even entire floors of skyscrapers that are built around trading bonds and trying to guess where interest rates are going, well, along with all their lawyers, accountants, and tech support, they just wouldn't be needed anymore.
And we're not talking about a small number here. According to the source material for this explainer, this could affect tens of thousands of highly skilled workers. The argument goes that all these professionals would then be freed up to move into other parts of the economy, into what the proposal calls more, quote, socially useful sectors.
Okay, to really get your head around why anyone would even suggest this, you have to understand that it comes from a completely different way of thinking about government money. It basically throws out that whole government is like a household budget idea that we're all so used to.
This quote from the source really gets to the heart of it. It's saying that when governments issue bonds, they aren't really borrowing money out of necessity. It's more like they're just offering people a savings account at the central bank. So in this view, a bond isn't a loan the government needs, it's just a service the government chooses to provide. So let's put these two views side by side, because this is the key difference. The conventional view, the one most of us are taught, is that the government has to collect taxes or borrow money before it can spend, right? But the view behind this proposal is totally different. It says a government that issues its own currency can just create money to spend whenever it needs to, and that taxes and bonds are actually used for completely different reasons.
And that right there is the absolute core idea holding this whole proposal up. The argument is that if a government can create its own currency,
It doesn't need your tax dollars in its bank account before it can build a hospital or a road. It just spends the money into existence first. So that raises a pretty big question, right? If taxes and bonds don't actually fund government spending, then what's the point of them? Well, according to this theory, taxes do two things. First, they make sure we all need and use the national currency. And second, they act like a brake on the economy, pulling money out to keep inflation under control. And bonds? They're just seen as a tool for managing the amount of money sloshing around in the banking system.
All right, let's wrap this up and bring it all together. What does a proposal like this really show us? Well, it forces us to consider that a huge chunk of our modern financial system isn't some law of nature. It's actually just a series of policy choices that could, theoretically, be made very, very differently. If there's just one thing you take away from all this, let it be this central argument right here. The entire proposal really boils down to this single idea. For a government that creates its own currency, paying interest is a policy choice. It's not a financial necessity. It's something it chooses to do, not something it's forced to do. And so all of this leaves us with a pretty provocative final question to chew on. If a government really can create its own money, then what is the true purpose of interest, taxes, and bonds? A proposal like this really forces you to step back and question the economic answers we've always just accepted as fact. It suggests that maybe, just maybe, those aren't the only answers out there.